Hello, my name is Haden, Lacey. Today I'm going to explain the importance of consumer regulation in Australia and the relevant legislation involved. In the book Financial Markets, Institutions and Money, the author describes the need for consumer regulation as the regulatory philosophy behind many of the consumer regulations is twofold. Consumers generally have unequal market power relative to creditors and other market participants, and consumer markets, when left to their own devices, will not allocate credit in the most socially desirable manner. In Australia, the majority of consumer regulation is governed by the Australian Securities and Investment Commission, or ASIC. ASIC's major sources of authority when dealing with consumer regulation comes from the Financial Services Reform Act 2001, the Consumer Credit Code, or CCC, and the Banking and Financial Services Ombudsman. In 1996, the federal government decided that Australia's financial system, structure and regulation needed to be reviewed and improved. A financial system inquiry named the Wallace Report was commissioned, which gave life to the Financial Services Reform Act 2001, or FSRA. The Financial System Inquiry released this statement on what they hope to achieve. The inquiry will make recommendations on the nature of the regulatory arrangements that will best ensure an efficient, responsive, competitive and flexible financial system to underpin strong economic performance consistent with financial stability, prudence, integrity and fairness. Key amendments to the Corporations Act made by the Financial Services Reform Act include licensing and conduct of the financial service providers, a single authorisation procedure for financial markets and clearing and settlement facilities, as well as product disclosure requirements. Single licensing was introduced aimed to provide minimum standards of training for financial institution employees advising clients on financial products. Licensing under a single authorisation procedure was aimed at addressing the lack of competition among financial markets. This new procedure ended the distinction between securities and futures exchanges. In the past, there were several avenues for legislation. This authorisation moulded them together into one. Product disclosure of financial services and products increased dramatically under the Financial Services Reform Act with the introduction of three disclosure documents: the Product Disclosure Statement, PDS, the Statement of Advice, SOA, and the Financial Services Guide. The book, Personal Finance, the 4th edition, the authors explained the Consumer Credit Code, saying that the Consumer Credit Code aims to protect customers through the enforcement of credit protection laws, fair trading, and the principle of truth lending. To comply with the code, lenders must formally disclose key information to borrowers. This information includes financing charges and the annual percentage rates. It must also be noted that the CCC has both civil and criminal penalties for breaching these codes. The Australian Uniform Credit Law Agreement 1993 is legislation that developed a template scheme which allows changes to the code and regulations to be updated on a national scale.
Are there any other regulators other than ASIC?
Well, yes, with the Australian Banking and Financial Service Ombudsman, ASIC plays a role, but so does the ACCC. They have a joint effort to do that, which I'll show you now. The Australian Banking and Financial Services Ombudsman is an independent dispute resolution service that considers complaints made against banks and their affiliates that operate in Australia. The BFSO scheme allows individuals and small businesses to pursue complaints in relation to the financial services as an alternative to court action. The resulting determination of this complaint with the BFSO is binding. With banks continually diversifying into non-traditional finance services, the Financial Ombudsman Service was created. The FOS is a single contact point for consumers which covers ADIs, general and life insurance companies, financial planners, stockbrokers, and managed funds. Consumer regulation plays a key role in minimising the financial system's two natural flaws of unequal consumer market power and the unsocial allocation of credit resources. The three main sources of consumer protection are the Triple C, the FSRA, and the BFSO, which all contribute to the framework of consumer protection which promotes a fairer market with more integrity. Thank you.